Safe investments. Are you an investor that dreads seeing red if you log into your investment accounts? And does the market volatility keep you up at night and concerned? Well, many of my clients over the past 20 years have told me, Anita, I just want to be invested in something that is safe, especially my female clients. So in today's video, we're going to dive into what is a quote unquote safe investment. From there, I will take you into a hypothetical case study where I look at someone who does invest safely for a 30-year time period. And I will ultimately give you my recommendation for what that client could have potentially done. And if you stay with me to the end of the video, I have a bonus offering for you all. My name is Anita Neifelt. I'm a founder of Viridian Wealth Management, where I help clients get retired and stay retired. I'm a certified financial planner and a fiduciary. If you like videos and content like this, then please like and subscribe. All right, let's get started. Before we dive into what a safe or low risk investment is, I want to have a bit of a disclaimer. When we're talking about safe or low risk, that is all relative to the situation and the person and the time. So for example, if we have an investor and they do invest in a low risk investment with the majority of their money for a long period of time, that in itself is a risk. It's a risk that you are not keeping pace with inflation. So it is all relative, and I wanted to make sure that I put that out there before we move on in the video. So let's now look at what is a low risk investment. Low risk investments are generally considered to be savings accounts, money markets, CDs, treasuries, US bonds, and some types of annuities. With safe investments, you're putting your money in the product, and some products you can get access to the next business day or the same business day even, while other products may have a term or a period of time that you have to leave your money in there. For example, if you have a CD, typically CDs can have different terms or lengths of time that you put your money into them. It could be 3 months, it could be a year, it could be 5 years. So you have to leave your money in the product for whatever period of time that the product states. Another thing to know about low risk investments is generally the yields are either at inflation or below potentially. And so these products are not well known for having returns that are in excess of inflation. So to recap, with safe investments, they're generally pretty liquid, or they can have a term, and your return or your yield on those investments is going to be probably somewhere around inflation, maybe a little bit less potentially. Now, let's move on to the pros and cons of safe investments. Now, the first pro of safe investments is the preservation of your capital. When you put your money in a U.S. Treasury, you know that that money has the backing of the full faith and credit of the U.S. government. Doesn't get any safer than that. The second pro that you have with investing in low risk investments is that you have stability. You're not waking up and hearing the market was down, this and that. You know that when you put your money in a savings account, if you put 30,000 in at the end of the year, you're probably going to have 30,000 with some interest. And the third pro is that you have a reliable source of income. And this can be really great for people who are in or around retirement because they have that steady stream of cash flow coming in to meet their needs. Now that we've taken a look at the pros, now let's look at the cons. Now, the first con that you have with low risk investments is the yield. Your yields are not going to be in excess of inflation. The second con that we have with safe investments is that you are going to have your money potentially locked up for a period of time. And with that money being locked up for a period of time, it presents you with the situation of, hey, interest rates have increased. Maybe I want to take money out of this product and put it into a higher yielding product, but I can't because I'm supposed to be here in this product for a 3-year term. Sometimes these products will allow allow you to withdraw money before the term is up, but it usually is not to your financial benefit. The third thing that we want to look out for with low risk investments is that you are not keeping pace with inflation, so your purchasing power goes down. You're not able to generate returns that are in excess of inflation. So to recap, with low risk investments, we have investments that are stable, have a reliable source of income, and preserve your capital. But some of the downsides are that you're going to have a lower yield, your money might be locked up for a term or a period of time, and you're not keeping pace with inflation. Now, we're going to move on to our hypothetical situation. We are going to take a closer look at Sally. Sally is completely hypothetical. We're just using her as an example today. So she's a single mother of one. She's raised her son for the past 30 years. She's worked as a teacher, was able to put money into her pension plan, and also on the side, every month she put $100 into a savings account. Now that she's getting closer to retirement, she's realized, hey, this money has grown all the way to $38,000. She got a great interest rate of 0.25% from her savings union over that time period. And so now she has this $38,000 saved. But could Sally's situation have turned out a little bit better? Sally could have met with a professional like myself to go through her financial picture. What I do with clients is I do examine the whole picture to see where are the opportunities for us. The first thing that I would walk Sally through is making sure that she has an emergency fund. She needs to have at least 3 to 6 months of essential expenses in that account. Now, since Sally is a single mother, she should probably have 6 months of essential expenses. Step number 2 is going to be looking at her debt. Does Sally have any high interest consumer debt besides a mortgage? If so, she should be putting that extra money towards that debt. We want to get the debt cleared out so that Sally can go ahead and move on to step 3. And step 3, we would take a look at any kind of short-term goals Sally may have. So does she need to buy a new car? If she wants to go on a nice trip, does she need to be saving up for that? So we would see if there's any upcoming goals that we should be setting aside money for. But also, for example, let's say that Sally doesn't have a need for a new car in the short term. It would be a good idea for Sally to still start setting aside money every month towards her next car purchase. And since she doesn't need a new car immediately, we actually have the ability to invest that money that she would be setting aside for the car. Once we have identified her needs in step 3, we would move on to step 4, which is going ahead and saving and investing that money for retirement. And so since Sally is a teacher, teachers typically have access to a 403B plan that she can invest in. So the first place that we would investigate is her 403B plan if she wanted to retire at a regular age. The 403B plan could potentially give her the option to make Roth contributions into it. So we would investigate that. If she didn't have that option, then maybe we would look at a Roth IRA. Or if Sally knows that she wants to retire early, we would look at funding a brokerage account so that she has a nest egg set aside that she can access before retirement age. Now, once we put that money into those various accounts, the second step that you really have to make sure you do is to invest it. So we can't just fund a Roth IRA. We actually need to put the money into an investment within the Roth IRA. So making sure that Sally has that set up would be a crucial part of the steps because we can't get the compound interest happening on that money if it's not invested. For example, if Sally would have invested that money in maybe more of a growth allocation, she could have ended up with close to $121,000 today versus her $38,000. So that brings me to our bonus offering. One of the things that I really enjoy doing with clients is in-depth financial planning. So if you made it this far in the video, I'm offering some complimentary financial planning sessions. All you need to do is click the link below in the box to schedule a time. Now, this is an offering that normally costs between $1,000 and $3,000 for a session, so you should definitely take me up on it. As always, if you enjoyed this video, please be sure to like, subscribe, and leave a comment below, and also share this with a friend that might find this information helpful. Thank you and have a lovely day.